Hello, friends. How are you? Hope so. You are doing very good. Anna. Today's our third lecture on non-resident taxation. So, in earlier two lectures, we studied about the residential status, and then when we say that an income deemed to accrue or rise in India. Today, we'll discuss. We'll do some advanced. We'll go a bit advanced in this series, and we'll do the presumptive, the capital gain, qua non-resident, and the tax rates. Before starting that, let's start with a good quote I read today only. The quote was, uh, the magic you are waiting for is in the work you are avoiding. Such a beautiful quote. It says, the magic, whatever the magic we all are looking for, we all are waiting for, can happen with us, provided we do the work which is required for such magic. So the magic which we are looking for, which we are waiting for, is in the work we are avoiding. If the magic is the rank in CA exam, the work is the study, the detailed study. Whatever the ICAI wants, we'll do that. If the magic is the great body you want, the work is the exercise. So everything is possible. Whatever magic we are waiting for, we are looking for in our life, can happen provided we do the work which we are actually avoiding. What's the problem is that we only wish, we don't do. And wish doesn't do much. Yeah. It's the doers who actually get the lion's share. So with this quote, let's start our lecture number 3 on NR taxation. Today, we'll discuss, we'll start with the presumptive taxation for non-residents. What do you mean by presumptive taxation? Presumptive means the government or the law presumes. What it presumes? It presumes the income. See, there is a settled principle of law that tax can be levied only real income. Only real income can be taxed, not the notional income, except the notional income which are specifically stated in the Act. So, can the government tax the presumed income? Presumed income means it's not the real income, it's a presumed income. They can, because it's specifically provided. And it's not that they're taxing you unreasonably, it's in the favor of assessee as well. There's a presumptive taxation case of resident as well. If you guys know, can you tell me what are the provisions for presumptive taxation for residents? I tell you, it's section 44AD and 44ADA. Perfect, Mr. Sanjay. So these two sections also give the option to the resident assessee to offer its income on AE as well. Good. To offer its income on presumptive basis. Means it will help because in such case the assessee is not required to maintain books of account. So it's a win-win for both the tax department as well and also for the assessee, because what the assessee does, he just aggregates his receipts, apply the presumptive rate, and offers tax. So whatever the expense he has incurred, whether they were genuine or not, they were incurred in cash, in bank, it's not relevant. So a lot of hustle and bustle is saved because of this presumptive taxation. With the same logic, government has introduced some 4 or 5 sections for presumptive taxation of non-resident. 4 or 5 section means it depends upon the nature of the business of the non-resident. There are different sections depending upon different nature of the business for which presumptive taxation is allowed. So we'll start with first section 44B. This is qua shipping business. So if the non-resident is into the shipping business, then he he shall offer its income on presumptive basis. And what is the presumptive rate? It's 7.5%. So what does it mean? It means that whatever revenue the non-resident driving from its shipping business, Qua India, only 7.5% shall be deemed to be the income of the non-resident. See, had it not been there, had the section 44B is not been there, then it would be a great difficulty for the non-resident to actually compute its Indian income. He would, of course, be easy to get the amount of the receipts in respect of India. But the expenditure, which are generally common for the ship, has to be apportioned qua India, qua that receipt, and also such expenditure to claim such expenditure, whether the same was paid in cash, TDS was deducted or not, a lot of complexity would have arisen, and therefore it would be very difficult for the shipping company to offer the income on net basis. And therefore, the government came up with Section 44B, which says that if the non-resident is engaged into the shipping business, then if he offers 7.5% of his Indian revenue, we'll discuss what do you mean by Indian revenue, then this 7.5% shall be the PGBP. And we will apply the tax rate. Okay. If amount is received in India, it's taxable in India. I have to aggregate these two amounts and then apply my 7.5% rate, presumptive rate. The resultant amount is the PGBP. Okay. This is my profit, which shall be taxable in the hands of non-resident. So, what the section says? Section says, notwithstanding anything contained section 28 to 43A. What are these section 28 to 43A? They are PGBP sections. So, this section 44B overrules my entire PGBP Act, meaning thereby I will not be allowed to claim any deduction. Okay. My entire PGBP Act 28 to 43A have been overruled. So, notwithstanding anything contained in section 28 to 43A, in case of non-resident, this section applies to the non-resident. Whether you're non-resident or you're a foreign company, applies to both, whether you're individual or a foreign company. Carrying on shipping business, other than cruise ship referred to in section 44 BBC. We'll study this in a minute. Carrying on ship. 7.5% of the following amount shall be deemed to be the PGBP. Amount received in respect of carriage of passenger or ship from any port in India or amount received in India. Okay. The amount of carriage includes the amount received by way of demurrage charges, handling charges, or any other amount of similar nature. So what this carriage amount, what in respect of this amount, I will also add the demurrage, the related demurrage and handling charges. What are demurrage charges? Anybody know? Come on. The demurrage charges means charges for waiting. Perfect. Charges for waiting. Actually, if the customer does not pick the goods from the seaport, then the shipping company levies a penalty charges. These are called demurrage charges. Handling charges, charges for loading, unloading, whatever. So whatever amount the shipping company is receiving, these two things. What? One is for carriage of passenger goods from any port in India, or whatever amount is received in India. Both these amounts shall be treated as Indian revenue, and 7.5% of this Indian revenue shall be treated as income of the shipping company, taxable under head PGBP in India, Indian taxable income. Okay. No other deduction shall be allowed because it overrules section 28 to 43A. Okay. Question 1. Tell me whether the brought forward losses shall be allowed against this 7.5% income. Come on. Yes or no? So, answer is no. Sanjay is saying no. Why? Any reason? The answer is yes. The brought forward loss shall be allowed. I tell you why. Because it only overrules section 28 to 43A. and brought forward losses are allowed under chapter 6. So my brought forward losses shall be allowed, but keep in mind, brought forward unabsorbed depreciation shall not be allowed. So why this discrimination? Tell me why this discrimination between the unabsorbed depreciation and the losses? So the act always discriminate between the depreciation, brought forward depreciation and brought forward losses. Why? Because perfect. Because brought forward depreciation is carried forward in section 32.2, and 32.2 is a part of PGBP. My section 44B overrules the entire PGBP, and therefore it overrules the section 32 as well. Therefore, any brought forward depreciation shall not be adjusted against this income, but brought forward losses or chapter 6 deduction can be adjusted against this 7.5% income under section 44B. Yes, Mr. Sanjay, perfect. Good. Okay, so this is for a small note. Section 44B overrides section 28 to 43A. It does not override chapter 6. Hence, brought forward business loss can be set off against income computed under section 44B. However, unabsorbed depreciation cannot be set off against this income. You understood the logic. Great. Section 1. Okay. So this was all about the section 44B, which is the presumptive taxation qua in respect of non-resident for its shipping business. My dear friends, there is one more section, section 172. This is also a section which applies on non-resident engaged in shipping business. Yes. There is overlapping. We understand how we need to do to build a bridge between them. So what does section 172 say? It says a non-resident who is engaged in the shipping business shall be taxable at a presumptive rate of 7.5%. Yeah, similar, whatever was there in section 44B. So why there's a separate section, we'll discuss in a minute. You'll understand. Section 172 says, if there is a non-resident who is engaged into a shipping business, then his income shall be taxable 7.5 at that 7.5%. But section 172 applies only in respect of income which is accrued or arise in India. It does not apply on income which is received in India. It means section 172 applies in respect of carriage of goods or passenger shipped from any port in India. Any port in India. So, if the passengers or goods are shipped from any port in India, then section 172 says you pay 7.5% on such carriage, and that will be your income qua such revenue. Okay. What's the difference between section 44B and 172? See, 44B is within the PGBP head. It is to help you to compute your business income, Indian income from Indian business income from shipping business. The purpose of section 44B is how the income of a non-resident engaged in shipping business shall be computed. But the intent of section 172 is different. Section 172, my dear friends, is a complete code in itself. It says how the income is computed. It says 7.5%. Then it will say at what rate it will be taxable, rate of tax rate. Then it will say how you pay that such tax, payment of tax. Then it will say how the return of this tax payment shall be filed. Then it will say how the AO will do the assessment. So, you understood this entire thing. So, section 175 is a complete code from computation of income till payment of tax, till filing of return, and till the assessment is done. While section 44B has a very limited scope of only computation of income. Okay. But there's one small problem. Section 172 applies only in respect of income accruing or arising in India. It doesn't apply on income received in India. We'll do the practical question. Don't worry. So what does section 172 says? That the non-resident engaged in the shipping business is required to pay the income shall be 7.5% of the amount he received in respect of carriage of goods or ship or goods or passenger shipped from any port in India. So it's also presumptive tax rate, 7.5% of the revenue. Revenue qua carriage of passenger goods shipped from any port in India. Only accrue. This income shall be taxable at the rate applicable to foreign company. So section 172 says that the tax rate shall be levied which is applicable to foreign company irrespective of the fact whether you are individual or a company. So even if you are individual, non-resident individual, still the tax rate which is applicable on you is as applicable to foreign company means 35%. This is not the case in case of section 44B. Then third, the section 172 says that the master of the ship shall pay this tax, shall file the return before departure of the ship from any port in India. It says India will not allow a ship to depart unless it pays the tax as per section 172. So what the law says? Law says we at least need a tax on the income accrue or arise in India. So before the ship departs, once the ship departs from Indian port, I don't have any control, but therefore before it departs, I will not allow the departure. The custom authorities will not allow the departure till the time the master of ship has paid this tax. Tax means, you understood? Income accruing arising, 7.5% of such revenue. Then apply the foreign tax, the tax rate applicable to foreign company, 35%. Whatever the amount, you pay this tax, you file the return immediately during the previous year itself. And once you file the return, then the AO has a time of 9 months from the end of the financial year in which return was filed to make the assessment. So this is the whole procedure of section 172. What is the intent? Intent is that Indian government doesn't lose its revenue. Why? Once the ship departs from Indian port, it will be difficult for the Indian government to collect its tax revenue. And therefore, section 172 says you on the income accruing or arising in India, you have to pay the tax before the ship departs. You with me? Okay. So let's see. Section 172. Notwithstanding anything contained in the Act. See, section 44B was overruling only the PGBP head. But section 172 overrules the entire Act. The entire Act. We'll see the implication of this. In case of non-resident engaged in carrying on shipping business, very good, and deriving income from carriage of passenger, livestock, mail, or goods shipped at any port in India. See, only point 1 is covered here. Point 2 is not covered. So, the income is derived from carriage of passenger, goods, livestock, mail, or goods shipped at any port in India. So, we are talking about the income accruing or arising in India. 7.5% of the amount received on account of above carriage, including damage, handling, or similar charges, shall be deemed to be the income accruing or arising in India in respect of such carriage. Presumptive income, recovery mechanism. Master of the ship shall prepare and furnish a return of his income, referred to in this section, to the AO before departure of the ship from any port in India. So he has to pay the tax and furnish the return before the departure of the ship. AO may allow that such return can be filed within 30 days of departure of the ship by a person authorized by the master. If AO wants, he may specifically allow, okay, you can depart and you can file the return within 30 days, provided AO is satisfied, tax officer is satisfied, it is not possible for the master of the ship to furnish the return before departure, and master of the ship has made satisfactory arrangement for filing of return and payment of tax. So if AO explicitly, personally gives the approval that ship can be departed, and he is satisfied that the master of the ship has made prescribed arrangement for the payment of the tax revenue will not be foregone, then he can allow the ship to depart without filing the return, without payment of tax. The question is, presumption that shipping business will not be traceable in Section 172 will also apply to Section 44B. Then why is there two different sections? See, I didn't get the question completely, but I'll tell you why there are two different sections. Section 44B is only in respect of computation of income. But Section 172, the primary intent of Section 172 is the collection of tax. So it says that ship shall not depart unless it pays the tax within the previous year itself. Okay, so that's why there are two different sections. So Indian government says, at least on the income accruing or rising in India, I need the tax right now, so that I may not have the control once the ship departed. On receipt of return, the AO, return of income, the AO shall determine the tax payable computed at the rate applicable to the foreign company. So tax shall be computed at the rate applicable to foreign company, irrespective of whether the assessee is individual, partnership, whatever. The tax rate shall be applicable, which is tax rate shall be of the foreign company shall be applicable. And such sum shall be payable by the master of the ship. The AO shall pass the above order within 9 months from the end of the financial year in which the return is furnished by the master of the ship or person authorized by him, as the case may be. For the purpose of determining tax payable by as above, AO may call for such accounts or documents as he may require. So, if the ship departed in November 25, so assuming the return was filed in November 25 itself, then AO shall pass the order by close this year, 31st March 26, and 9 months from the end of the financial year, means 31st December 26. So AO shall pass the order by 31st December 26. A port clearance certificate shall be issued by the custom officer only when he is satisfied that the tax payable under this section has been duly paid or that satisfactory arrangement have been made for the payment thereof. Understood? So the custom authority will not allow the ship to depart unless they are satisfied that the tax has been paid or satisfactory arrangement has been made. The assessee may, before the end of relevant assessment year, claim that an assessment be made of his total income in accordance with other provisions of the Act. What are these other provisions of the Act? This is Section 44G. So an option is given to the assessee. If he wants, he pays before departure, he will pay the tax. But if he wants, before the annual assessment year, he can say that, please assess me under Section 44B, not under Section 172. In such case, tax paid by assessee under this section shall be deemed as advance tax. Here, explain. What happens is that once a ship leaves from any port in India, every ship, it's mandatory for them to comply with Section 172. So whatever goods or passenger they shipped from the port, the carriage they have received in respect of such goods or passenger, they shall compute their income at the rate of 7.5% of such carriage. Then they apply the tax rate on this income, 35% plus surcharges as the case may be. Then they will pay this tax and file the return. This is mandatory. There is no other option. If the ship is departed, then they have to do all this. But subsequently, if they find that Section 44B is more beneficial to them, then before the end of assessment year, they can ask the tax officer to pass an order under Section 44B. Now, when the Section 44B shall be beneficial? One, if you are an individual, then the tax rate under Section 44B shall be concessional as compared to the foreign company. Two, tell me, what is the other difference? In case of Section 44B, you are eligible for brought forward losses. But if you see section 172, it overrules the entire act, not only the PGBP. And therefore, even the brought forward losses or the deduction under chapter 6A is not available while paying the tax under section 172. 172 is very temporary arrangement. Okay. So while paying tax under 172, you just do the 7.5%, compute the tax, apply the tax rate, and pay the tax. But subsequently, you can say, apply the correct tax rate, which is applicable to me, allow me brought forward losses, allow me deduction, if there is any. Whatever is left shall be my income, which shall be taxable at the rate applicable to such assessee. Understood the procedure? One more thing. See, section 172 overrules the entire act. Means it overrules the previous provision as well. Meaning thereby, if the shipping company is paying tax under section 172, then the payer is not required to deduct tax on payment to such shipping company. See, there is a small table. Section 172 overrules the entire act, hence previous provision also do not apply. The payer is not required to withhold tax on payment made to NR or his agent, hence 195 or 196 shall not apply. Difference between 44B and 172. 44B considers two types of income, income accruing or income received. 172 dealt with only income accruing. Presumptive rate is same in both the cases. It is only for the computation of income, 44B. But it's a complete code. Computation, filing of return, and the assessment. The normal tax rate shall apply whichever is applicable to the assessee. But flat rate of 35%. Tax rate applicable to foreign company shall apply irrespective of the assessee. It overrides the PGBP head, it overrides the entire act. Since it overrides only the PGBP head, the brought forward losses can be set off. But since it overrides the entire act, neither the brought forward losses nor the unabsorbed depreciation nor the reduction shall be allowed. No set off, neither unabsorbed depreciation, no deduction. But here, 44B deduction is also allowed. Here, the payer is required to withhold tax, FA is not required to withhold tax. Okay, you're with me? Let's do some question. It will give you a confidence how to interpret this. Okay, let's start with simple questions. Seaport Shipping Limit Line are non-resident foreign companies engaged in the business of carriage of goods shipped at Mumbai port. So, it's a non-resident company. It's engaged in shipping business. During the previous year ended 31st March 2026, it had collected a freight of 100 lakh, damage charge of 20 lakh, and handling charge of 10 lakh. The expenses of operating its fleet during the year for the Indian port were 1110. Compute its income applying the presumptive provision. So I don't have an option. I have to apply the presumptive provision. There is no option. So, in case of applying the presumptive provisions, the expenses shall not be allowed. So this 110 lakhs has no meaning for me. It's not relevant. It's not allowed. What I'll do, I'll just add the receipts and apply 7.5%. So my receipts are 100 lakh, 20 lakh, and 10 lakh. So 130 lakh into 7.5%. This is my income, which comes to 9.75 lakhs. 9.7. Simple? Good, Sanjay ji. Can the brought forward losses and unabsorbed depreciation be set off against profit determined under section 44B? So, partly correct. No, not the complete one. Brought forward losses can be set off, but not the unabsorbed depreciation. You understand? We discussed this. A non-resident individual engaged in the business of operational ship received 1 crore for carriage of goods from India. Okay. So the NR individual. He also received handling charges of 5 lakh from the customers in India. To earn these income, expenses amount to 10 lakh and depreciation amount to 30 lakh. The SSC also has a manufacturing business in India whose brought forward loss is rupees 2 lakh. Compute the total income of non-resident assessee. Now see, now you will understand. So what's the fact? There is a non-resident individual who is engaged in the shipping business. He received rupees 1 crore for carriage of goods from India plus handling charge of 5 lakh. So his receipts are 1 crore 5 lakh. Then the question provides the expenses which he has incurred for earning this income, which is irrelevant for me. So I'll ignore that. The question asks for total income. Okay. So what will happen? First, I have to compute the total income under section 172 because it applies in all cases. Whether you want to go 44B or not, it applies. Because at the time of departure, you have to file your return as per 172. Subsequently, you can go for 44B if you want. So, but here there is no. Once I apply 172, my income would be 1 crore 5 lakh into 7.5%, which comes to 7,87,500. I have a brought forward loss of 2 lakh. This shall not be allowed under section 172 because it overrules the entire act. Okay. Now, on this 7,87,500, I'll apply 35% tax rate. Even if I'm individual, I have to pay a tax at the rate of 35%, which comes to 2,75,625. If I apply the cess, so my tax come to 2,86,650, which the non-resident individual would pay at the time of departing his ship during the previous year itself. But subsequently, he will do its computation under section 44B as well. So, if I do the computation under section 44B, what will happen? My receipt will be 1 crore 5 lakh. I'll apply 7.5%, which comes to 7,87,500. But under section 44B, I will be allowed a deduction of brought forward losses. That's allowed under section 44B of 2 lakh. So my income, PGBP income, is 5,87,500. I hope you are with me. Now on this income, I'll apply the tax rate applicable to the individual. Assuming he opts for the old scheme, then the tax rate shall be 31,200. He had already paid the tax of 2,86,000 at the time his ship departed from a port in India. So he will get the credit of such tax and he will get a refund of 2,55,450. Hope you are in. Now you understood. So first, whenever the ship departed, the ship makes a computation as per section 172, pays the tax, whatever comes. Now subsequently, he does the similar computation under section 44B, and if 44B is beneficial, then it goes for the 44B, and he has a time to go for 44B up to the end of relevant assessment year. Understood? Sanjay ji, now understood? Sure, good. This is a little tricky point, so it's better you understood. This interplay between 44B and 172. We'll do one more question, so that the concept is actually clear. A ship owned by NRI comes to India and receives, again he's an NRI individual, and receives 60 lakh for carriage of goods from Bombay. Okay. The ship also received port handling charges of 10 lakh for these goods. Okay. Further, 40 lakh is received by him in London for carriage of goods from Bombay. Okay. So this 60 plus 10 plus 40 is for carriage of goods from any port in India. Is accrue arising in India. Okay. This comes to 110 lakhs. The agent of NRI also received 90 lakh in India for carriage of goods from UK to US. So here the goods were carried from UK to US. It doesn't accrue to arise in India, but this amount is received in India. So it should also be taxable in India. Okay. Expenses claimed to earn above income amount to 170 lakh. Ignore. Nothing. Just ignore. There is also brought forward loss of 1 lakh from some other business. Okay. Compute the tax liability of assessee under section 172. Okay. So I'll do it. Treat it as a real life practical example. So in this case, there are two types of income. Accruing 110 lakh plus income received in India 90 lakh. So in this case, section 172, it's applicable only to 110 lakh. So at that time, the ship was departing from India. The master of the ship has to pay tax only in respect of 110 lakh. This is section 172. But in this case, if he doesn't have any other income, then it is optional for him to furnish the regular return. If he wants to opt for 44B, qua this income only, then he will opt for this return, he will opt for 44B and claim the refund, because he will opt only if there is a refund. Is there option also not to claim section 44B? This option is available only if you have an income which is accruing or rising. If you have also income received in India, then you have to compute the tax under section 44B. Okay. But if assessee has other income as well, means he has income in respect of accruing or rising plus receipt, then he doesn't have an option, he has to furnish the return of income. But in return of income, he has an option whether to show only this income, and this income has already been taxed under section 172, forget about it, or to show both the income and claim 44B and claim the credit of tax already paid under section 172. The shipping and aircraft, that will apply irrespective of the nature of the assessee or individual, everybody. But 44BBB, triple B, applicable only to the foreign company. Sorry. Engaged in the business of civil construction or business of erection of plant or machinery or testing or commissioning thereof in connection with turnkey power projects approved by Central. Again, the presumption is that this presumptive section is applicable only in respect of turnkey power project. So it's not applicable on other turnkey projects. For other turnkey projects, you have to compute your income as per normal provisions of the Act. Under that PGBP after allowing expenses and all. Then 10% of the amount received in this behalf shall be deemed to be the PGBP. Okay. So first, it's applicable only to the foreign company. Second, it's applicable only in respect of power project. Then the presumptive rate is 10%. But here the third difference and the important difference is that this is optional. 44B and BBA, the shipping and the aircraft provision, were not optional. It says assessee may claim lower profit if he keeps and maintain books of account and gets his account audited. So similar to 44AD and ADA, it's not mandatory. It says, okay, if you feel 10% is quite high, you maintain your books of account, you get them audited and furnish the return on that basis. And I'm happy with it. So section 44 BBB gives an option. Then section 44 BB. It's applicable in respect of companies like ONGC. So the companies like ONGC, they do a lot of extraction of mineral oils from the seashores and all. Reliance, ONGC. So what the section 44 BB says? If there is a non-resident which gives the consultancy, technical consultancy, or provides some facility in which helps or provides some equipment which is used for extraction of this mineral oil, then the income of such foreign non-resident may be taxed on presumptive basis at the rate of 10%. Okay. So let's see. It says, in case of non-resident engaged in the business of providing service or facility in connection with or supplying plant and machinery. So whether the non-resident is providing a service or providing any equipment which is used in prospecting for or extraction or production of mineral oil. whether the service or equipment is to look for whether there is an oil or not, is prospecting, or for extraction or production of the mineral oil. Mineral oil means petroleum natural gas. Then 10% of the following amount shall be deemed to be the PGBP. So in case of shipping company, it was 7.5%. In case of aircraft, it was 5%. In case of turnkey project, it was 10%. Now here for the mineral oil, again 10%. 10% of amount received in or outside India for the aforesaid activities undertaken in respect of prospecting, extraction, or production of mineral oil in India, accrue rise in India, if the activity is undertaken in India, or amount received in India. So the aforesaid activity is undertaken in respect of prospecting, extraction, production of mineral outside India. Understood? So accrue or receive. Here also the assessee has an option to claim the lower profit if he maintains books of account and get them audited. The important part. Section 44BB does not apply where Section 115A or 44D apply. Means if the services are in the nature of technical services and they are taxable either under Section 115A or 44DA. We did this in the last class. The difference between the two is, in case of 44DA, the technical services are effectively connected with the PE of NR. In such case, it is taxable on net basis. But if there is no PE, if the technical services rendered from outside India, then they are taxable on gross basis under Section 115A. So what Section 44BB says? It says that if FT, fee for technical services, are otherwise taxable under Section 115A or 44DA, then apply such section. But if 115A or 44DA are not applicable, meaning thereby the services are not in the nature of technical services, then you will come to 44BB and the income shall be 10%. See, in case of 115A, the FTS is taxable at the rate of 20%. But this 20% is the tax rate. And 44BB gives you the income, 10%. And you will apply the tax rate on this 10%. So of course, 44BB is much more beneficial than 115A. Why? Because assuming there is a revenue of 100, then under Section 44BB, 10 shall be the income. And on this 10, assuming we have foreign companies, 3.5, 35% should be a tax. But if 115A is applicable, then on 100, no expenses, apply 20% tax rate, 20 is the tax. So under Section 44BB, it's 3.5, under Section 115A, it's 20. Okay? But they are not in the same field. 115A is applicable if the services are in the nature of FTS, technical service. We understood in detail in the last class. And 44BB applicable if it's not in technical service. Of course, in connection with prospecting, extraction, or production of mineral oil. Then recently, two new provisions are added in the list of presumptive taxation for non-resident. One is 44BBC. It's applicable if the non-resident is engaged in the cruise. So they take the cruise. Okay. 44B was applicable whether you take the passenger or goods. But 44B excludes the people, the SSC, if you are covered by 44BBC. So if you are taking cruise ship, then you are taxable under Section 44BBC. Here the presumptive rate is 20%. 44B was 7.5%. But here it says that if you're taking the people on cruise, then their margin are more. You will tax at the rate of 20%. The income rate is 20%. In case of non-resident engaged in the business of operation of cruise ship, 20% of the amount shall be deemed to be the PGBP. Amount means amount paid to the person on account of carriage of passenger or amount received by him. Okay. But 44BBC applicable only if you are actually engaged in the cruise ship. It says the non-resident has to operate primarily a passenger ship. So the ship primarily has to be a passenger ship, not a goods ship, not a what you call. It's not for the carriage of goods. It's for the carriage of passengers. And the carrying capacity of more than 200 passengers. So we're not talking about a small boat or something which runs in Goa and or they are talking about actual cruise ship. It has a capacity, must have a capacity of more than 200 passengers or length of 75 meter or more. It should have facility like leisure and recreational purposes and having appropriate dining and cabin facilities for the passenger. There should be dining and cabin facilities. We were talking about the cruise, what we see in the films and all. The non-resident has to operate such ship on scheduled voyage or shore excursion touching at least two seaports of India or same seaport of India twice. So it's not that you took from one port and come back. You have to touch at least two seaports in India. You should operate such ship as per the procedure and guideline, if any, issued by the Ministry of Tourism or Ministry of Shipping, as the case may be. So if you're running a cruise ship, then your profit is 20%. Lastly, 44 BBD. One more thing. In case of cruise ship, there is an exemption provided. It says there is a foreign company, say it is running a cruise ship and taxable under section 44 BBC. Okay. But it has taken the ship on rent from B. And B is also a foreign company. It is also a foreign company. And they are the file subsidiary. Means they come under the same holding. Then this rent of ship, which is paid by A to B, it shall be exempt in the hands of B. B is not required to pay tax on this rental income. So what did it say? The lease renter paid by a foreign company which opt for presumptive regime under section 44 BBC will be exempt in the hands of recipient company, company B, if such company is a foreign company and both these foreign companies are subsidiaries of the same holding company, means they are fellow subsidiaries. Okay. So we come to the next section, 44 BBD. What it says? It is to encourage the non-resident to provide facility, to provide service so that electronic goods could be manufactured in India. Because presently, most of the electronic goods are being imported, majorly from China, Japan, Korea. And to make the made in India concept more strengthened, this benefit is provided. So it says, a non-resident engaged in the business of providing services or technology in India for setting up electronic manufacturing facility. So what the Indian is doing, what the Indian company is doing, Indian company is setting up a manufacturing facility for electronic manufacturing facility. And for this, he needs a service of a foreigner, non-resident. So we are talking about the taxability of such foreigner, taxability of the amount which the such foreigner is receiving from this Indian company. So non-residents engage in the business of providing service or technology for setting up electronic manufacturing facility or in connection with manufacture or producing electronic goods, article or things in India. To a resident company, the services or technology is provided to a resident company which is establishing or operating electronic manufacturing facility or connected facility for manufacturing or producing electronic goods, articles in India under scheme notified by the central government, and resident company satisfy the condition prescribed in this behalf. So these services are provided to a resident company which is setting up an electronic manufacturing 5A, but if it's for electronic facility, then it's taxable under section 44 BBD, presumptive basis only. Okay, you with me? So I have a small portion here. So High Tech Drilling Limited has taken an oil rig on hire from Schlumberger Inc. of Germany. High Tech Drilling Limited has to pay higher charges of 4 crore during the year ended 31st March 25. Compute the income of Schlumberger liability tax. So we are talking about mineral oil section. So they have taken a oil rig on hire. So the profit shall be 10% of the revenue of 4 crore, meaning 40 lakh. Okay. So my dear friends, This completes our presumptive taxation under the Act who are non-resident. So we discuss about section for shipping, non-resident engaged in the business of shipping, aircraft, turnkey power project, prospecting, extraction, production of mineral oil, then cruise business, and lastly, electronics. 6 provisions we studied. Any doubt? Do let me know. Come on. Understood? If a question is asked from these sections, then believe that you must have helped a blind old lady to cross the road, because they are very simple questions and full marks can be obtained in this types of question. So whatever what the question says, it gives the revenue, you have to apply the presumptive rate and gives the income amount. Normally 4 marks question. How many marks question can be asked? So it's normally 4 marks question. The question which we did about interplay of section 44B or 172 is normally, I don't think has been asked in the exam till now. But if such type of question are, then it might be for 6 or 8 marks. Okay. Now we'll do a very interesting topic. You know about it, so we'll do it quickly. We'll just go as we do a little deep to understand why this provision was there. We do the capital gain relevant for non-resident point of view. Okay. So this first proviso to section 48. Let's see what is this. I think you know, but no worries. We'll do this. Let's first understand the problem statement. What happened is that assume there is a NR, Mr. A. He wants to invest in Indian share market. So what he does, he gives a $10,000. He brings this $10,000 in India. The rate of dollar was rupees say 70. And so he got rupees 7 lakh. And he purchased shares of say Infosys for this 7 lakh. The rate was say 1,000. So he purchased 700 shares of Infosys. Okay. Now at the rate of 1,000. Clear? Now what happened is that after some time, the Indian share market appreciates, the share prices increase, and the price of share Infosys increased to rupees 1,200. So he sold his share, 700 share at rate of 1,200. He got rupees 1,200 into 700, 8,40,000. Okay. Now he wants to take this money out. At that time, assuming the exchange rate was 85. So what he does, he 8,40,000 divided by 85, he got $9,882. And in his home in USA, after all this working. Understood? And now, so he brought $10,000, but when he brought at the rate was 70, but after a year when he sold the share and the rupee depreciated and the rate was 85, so he took out $9,882. So ultimately, if you see, he invested 10,000 and he got 9,882. He actually suffered a loss of $128. But the Indian government will not allow him to take $9,882. Indian government, what would Indian government would say? Indian government would say, you have invested in my share. Infosys is a company in India. You have invested in shares. You have made a profit. Why? Where is the profit? Have you gone mad? No. I'll tell you where is the profit. You purchased a share for 7 lakh rupees. You sold it for 8,40,000. So there's a profit of 1,40,000. And you must pay tax on it. What the SEC would say, have you gone out of your mind? I invested $10,000 I got 982. Where is the profit? I suffered a loss. You understanding? The two different versions of the same stories. Why this is happening? Because Indian government is making calculation in INR and the assessee is making calculation in USD. And both are right. The assessee would make a calculation in his own currency. I, as an Indian government, will make a calculation in my own currency. So I say, see, you have made a gain from my share for trading in my shares, trading of shares of my companies, and you made a gain of 1,40,000. I have nothing to do with the foreign exchange fluctuation. You pay tax, whatever left, take it out. So this was a issue with the non-resident. So non-resident went to the government, knock, knock, knock. See, this is a problem, and we cannot invest in you. Why? Because we know that your share market will rise. We have a strong belief in you, in your market. But what happened is that when we want to take money out, your rupee depreciate. And the loss we suffer because of this depreciation is more than the gain we have made in your share market. And above that, we are ready to take that risk. We will manage that. We are ready to take that risk. But over and above that, you ask tax on this notional gain, which actually I have not made. If you see, when I take out the money, you must see what is the net result. You're taxing me on the gain in INR. And the Indian government wants more and more foreigners to invest in India. Therefore, first proviso was inserted. First proviso to section 48. What is section 48? Section 48 gives the computation of capital gain. So now see, what does the first proviso say? The first proviso says that if you are non-resident, then I'll allow you to compute the capital gain in your currency. So you got $1,000, $10,000, right? In our example, and you took back $9,882. So there's a loss of $128, no tax. This was you want, granted. So this is granted by way of first proviso. First proviso says that if you are non-resident and the capital asset is share or debenture of an Indian company, the benefit is provided only qua share and debenture. If the foreigner, the non-resident, invests in the property, jewelry, or whatever, any other capital asset, then the normal way, what we discussed in INR only, the computation shall be done. This special computation of computing the capital gain in foreign currency is applicable only if the capital assets are share or debenture of an Indian company. And also, this share and debenture must have been purchased in foreign currency. So, in such case, what the government says, whatever sale concession you have received, which is 8,40,000 in our case, you convert it into dollars in the currency in which the shares were purchased. So at this stage, the exchange was 85. So I received 9,882. Okay. Reduce the transfer expenses, any expenses incurred in selling this share or debenture. So you convert those expenses, assuming they are incurred 8,500. You convert those expenses also in dollar, 85. Then reduce the cost. So cost was 7 lakh. We convert this also dollar, 70. Why 70? Because at the time when the cost was incurred, the dollar was 70. So 10,000. This is the net capital gain, which comes to minus 85. $9,797. Now, sorry, this is negative. 128 minus 80 plus 85. So this will come to $213 loss. So there is a loss. Don't pay any tax. No tax. Had it been profit, then assuming had it been $100 profit, Then you will convert it into INR at the rate of 85. Yes, sorry, expense shall be 100. But I hope you understood. Then it's only a mathematical issue. So had it been a profit of $100, then you will convert it into INR, and on this capital gain you will have paid tax. You understood? Any query? Okay. So let's study this. Capital gain arising to non-resident assessee from transfer of, so it's applicable to non-resident assessee. Transfer of capital asset, which capital asset? Share or debenture of Indian company, which were purchased in foreign currency. So, three conditions. The assessee should be non-resident, the capital asset should be share or debenture in foreign company, or in Indian company, I'm sorry. And lastly, these share debentures should be purchased in foreign currency. Then this capital gain shall be computed in such foreign currency, and capital gain so computed shall be reconverted into Indian currency. So I will first compute the capital gain in foreign currency, and whatever the capital gain is arrived, I will convert it into the INR. So for this conversion from Indian to INR to foreign currency and foreign currency to INR, I need exchange rate. So I'll use the exchange rate of average of TTBR and TTSR. TTBR means telegraphic transfer buying rate, and TTSR means telegraphic transfer selling rate. So whenever there is a rate for buying or sell foreign currency, the bank gives you two rates, buying rate and selling rate. So I'll take the average of these rates. For on which date? If I need to convert cost, I'll take the rate applicable on the date of acquisition. If I need to convert the expense or sale consideration, I'll take the date of transfer. By this, from these three items, I will compute the capital gain, which will be in foreign currency. Now, this capital gain shall be converted into Indian currency by applying the buying rate on the date of transfer only. Okay. Now, if you see, in this example, the non-resident purchased a share of Infosys. Now, subsequently, he sold this share of Infosys and got his 8,40,000. But instead of taking it back, he invests this in the share of Reliance. Now, subsequently, he sold the share of Reliance. Now, question comes, at the time of sale of share of Reliance, when I'm computing the capital gain on sale of Reliance share, whether I can apply the first proviso or not. Answer me. Whatever we have studied till now, if in case of sale of shares of Reliance, can I compute the capital gain in accordance with first proviso? I'll tell you, the answer is no. Why? Because there are three conditions. One is I should be NR, I am NR. Good. Why no? Second is the capital asset should be share or debenture of Indian company. It is share of an Indian company, Reliance. But third condition is this share should have been purchased in foreign currency. Here I have not got the foreign currency. I have got the foreign currency for purchase of Infosys shares. But now I have purchased the Reliance share from the sale proceeds in INR. So this first proviso cannot be applied on this subsequent transaction. But this is very illogical. You want that NR take this 8,40,000 outside India. Then at the same time, he brings back into India and invest in Reliance share. Why you want the NR to pay the commission? Without any logic. So therefore, it says the first proviso, aforesaid manner of computation shall also be applicable in case of every reinvestment. So once you have brought in foreign currency, in every reinvestment, Infosys, Reliance, Tata, Adani, whatever, in every case of reinvestment, the capital gain shall be computed as per first proviso. Okay. The benefit of currency fluctuation will not be available in respect of capital gain arising from transfer of long-term capital asset referred to in section 112A. So of course, if the tax is computed in section 112A, then first proviso is not applicable. Okay. So you understood the concept? Here, the non-resident got $10,000 at the rate of 70. So he brought 7 lakh, he invested in the share of Infosys. It was sold for 8,40,000. But at that time, the rupee depreciated to 85, and therefore he got only 9,882. So out of 10,000, he got 9,882. There was a loss of $128, and therefore no tax. So there will be benefit in second case also, that is by buying Reliance share also. Sorry, please explain. Yeah, in case of Reliance as well, the computation shall be done as per the first proviso. So you will convert the sale consideration, you will convert the cost into the US dollar, you will compute the capital gain in US dollar, and then you will reconvert the capital gain into INR. Okay. Now, in this example, let's change a small fact. At the time of sale, when this shares of Infosys was sold for 8,40,000, the assuming the exchange rate was 65. Now, how much amount? The sale consideration shall be in dollar, shall be 8,40,000 divided by 65. 12923. The cost shall be 10,000. So the capital gain shall be $2,923. I'll convert it into INR because now this is a capital and I have to pay tax. I'll multiply by 65. It comes to 2,923 into 65. 1,90,000. So this is the capital gain on which the NR shall pay tax. But if you see, the actual gain was 8,40,000 minus 7 lakh, only 1,40,000. But the government is taking me tax on 1,90,000. So why it has increased? It has increased because the rupee has appreciated. Earlier, it was decreased because rupees were depreciated. So actually, what the first proviso is doing, if you go into deep, if you understand the concept, first proviso is doing nothing. It's just allowing, is just changing the nature of exchange gain or loss. Is treating exchange gain or loss as in the capital nature. So the exchange loss is treated as capital loss and exchange gain is treated as capital gain. So in this case, 1,40,000 is the actual gain and 50,000 nothing but the exchange gain. The entire 1,90,000 is taxable as capital gain. You understood? So first proviso is beneficial if rupee depreciates, but it actually gives you a pain. It's actually harmful if rupee appreciates. If rupee appreciates, it did happen when this Infosys, Wipro, that .com thing was happening. Na? So the dollar was actually reducing and rupee was appreciating. Nowadays, again, rupee is depreciating. So whatever be the case, the first proviso is helpful to the non-resident when rupee depreciates. Why? Because in this case, the exchange loss is also allowed. It's also allowed to be set off against your capital gain. In nutshell, understand? By way of this manner, the computation manner is in such a way that it factors in the exchange loss. But if rupee appreciates, then the exchange gain is also taxable as capital gain. You understood? But do NR has an option? Answer is no. If you satisfy the condition of first proviso, then first proviso is mandatory. Okay? Let's do small questions. Mr. A non-resident Indian, remits $40,000 to India on 16/9/2006. The amount is partly utilized on 3rd October 2006 for purchase of 10,000 equity shares in A Limited, an Indian company, at the rate of 12 per share. Okay. So NRI, what he did is he remitted $40,000, and out of this $40,000, he invested a part of this amount for purchase of 10,000 shares at the rate of 12 rupees. So for 1,20,000. Okay. This share was sold for 48 per share on 30th March 2026. Okay. Fair market value of these shares on 31st Jan 2018 was 35 per share. Okay. The TTBR and TTSR of dollar adopted by SBI is as follow. Okay. Compute the capital gain on the assumption that these shares have not been sold through Economic Stock Exchange. These shares have been purchased and sold through Economic Stock Exchange. Ignore the provision chapter 12. Okay. Chapter 12, we'll do it in a moment, today only. Let's compute the capital gain. So, if this share was purchased and sold through Economic Stock Exchange, then 112A shall be applicable. And in such case, the first proviso is not applicable. Okay. So let's do first thing, where this share is purchased outside the Economic Stock Exchange. So my sale consideration is 4,80,000. See, 4,80,000. I'll convert this into US dollar by applying the average of TTBR, TTSR as on the date of transfer. The date of transfer is 30th March 2026. So average was 59 and 61, 60. So I'll apply 4,80,000 divided by 60. So the sale concession is $8,000. Right? The cost was 1,20,000. I'll apply the average of TTBR, TTSR as on date of acquisition, which is 3rd October 2006. So average is 20. So 1,20,000 divided by 20, it comes to 6,000. 3. When I purchased, the dollar was only rupees 20. Now when I sold, it rose to 60. So the rupee has depreciated so much. Even though I have earned, if you see, 48 minus 12, I have earned 36 into 10,000. 3,60,000 INR. But if you see in the dollar term, I have earned only 2,000, which amounts to 1,18,000. Because I have converted using TTBR, not the average. Remember it, TTBR. Everything is converted at average except the capital gain. So why is this so low? Because it factors in the exchange loss. Okay. So long-term capital gain shall be 1,18,000. If it is sold or purchased outside stock exchange. If it is sold or purchased in the stock exchange, then 112A shall apply. The sale concession shall be 4,80,000 only, but cost shall be 12 or 35, whichever is higher, subject to 48. The cost shall be 35 in the section 112A. The capital gain shall be 1,30,000. You with me? And there is simple example. See, can you repeat this? Of course I can. See, the question is simple. It says there is an Anna who has brought in foreign currency and invested in the shares of an Indian company. And after some time, it sold the shares. Okay. So question asks, what would be the capital gain had the share been listed, or second situation, if the share is not listed? If the shares are listed, then the tax shall be computed under section 112A, and section 112A says that first proviso shall not be applicable. In such case, the computation very simple in INR only. Sale consideration minus cost. But 112A says that for the cost, if the shares were purchased before 31st Jan 2018, then the cost is computed by a formula. And what's the formula says? That formula says that whatever the actual cost or the fair market value on 31st March 18, I will take whichever is higher. But this amount cannot exceed my sale price. So the cost was 12 and the fair market value was 35. I'll take higher, which comes to 35. And between 35, I have to compare it with my sale price, which is 48. So I have to take it 35. Okay, so this will be the cost. The sale price was 48, cost is 35. The difference is a capital gain if the shares are listed. This you have already done your capital gain chapter. So that's why I didn't go in deep in this. The reason of this formula and everything. If the shares are not listed, then 112A shall not apply. Then there shall be normal computation. And then first proviso shall apply. What does the first proviso say? You convert the sale consideration into the USD, the same foreign currency which was used to purchase the share. So for this conversion, I will use the average rate of which date? Date of the transfer. So the shares were transferred on 30th March. So I'll take average of BR and SR, which comes to 60. My sale consideration was 4,80,000 divided by 60. It comes to 8,000. Then I reduce the cost again in foreign currency. For converting into foreign currency, I'll take the average again, but on the date of acquisition. I acquired on 3rd October 2006. At that time, the average rate was 20. My cost is 1,20,000 INR. 1,20,000 divided by 20 gives me the cost in USD, which comes to $6,000. So my capital gain shall be $2,000. But to pay tax on capital gain, I need the capital gain in INR. I will again reconvert it into INR by applying the TTBR, not the average rate. Now, for this conversion, I will apply 59. TTBR as on the date of transfer. So this is the capital gain. Okay. Do ask if there is any specific query. I hope you understood. If not, do let me know. I'll again repeat. No worries. Okay. So other two questions are very simple. You can do them in homework. It's just the practice. Now we are moving to the next concept. It's very related concept. It's taxation rupee denominated bonds. First, what are these RDBs? See, these are also called the masala bonds. Yes. They are officially called, it's not the name, they are officially called the masala bonds. What are these? This is nothing. See, Indian company need to borrow money from outside of India. So what used to happen is that the foreigner, the non-resident used to lend money in foreign currency. Indian company has to return the money in foreign currency. So in this case, the foreign exchange risk has to borne by the Indian company. See, the Indian company would borrow $10,000 in year 1. In year 10, he has to repay $10,000. So if this time the dollar was say rupees 50, it got 5 lakh rupees. But now say dollar is 80, he has to pay 8 lakh as a principal. So this exchange loss of 3 lakh, this was borne by Indian company. So if a money is borrowed in foreign currency, the borrower has to bear the foreign exchange risk. But now India is a 4th largest economy, so it can dictate terms. So Indian company said that we can actually borrow in INR. The central government allow it, and they bring out a concept of rupee denominated bond. In this case, the Indian company shall borrow 5 lakh rupees and from outside of India and shall repay 5 lakh rupees. So in this case, the foreign exchange risk is transferred to the lender, non-resident. So he will give me 5 lakh and he will receive 5 lakh. If the rupee depreciates, then that cost has to be borne by the foreign resident, non-resident. Okay. But now assuming, see, let's understand this with the example. Here's the example. Here it is. A Limited issued RDBs of rupees 100,000 each, rupee denominated bond. Mr. X, a non-resident, subscribed to the bond of rupees 1 crore on 1st Jan 2015. And for this purpose, he remitted the equivalent USDs to India. Of course, he will. The bonds were redeemed at par on 31st December 2025. The exchange rate were as under. So what happened is that, so there is a non-resident who invested in the bonds of an Indian company for rupees 1 crore. And after 10 years, the bonds were redeemed at par. So once the bonds are redeemed, he will be liable to pay the capital gain. But he's a non-resident. And the capital gain shall be computed as per first proviso, section 48. So in this case, what will happen? The sale consideration 1 crore, we will convert it into USD. On 31st December, the average rate 64. The sale consideration is 1,56,250. I convert the cost also in USD as per first proviso, and this shall be the capital gain, $13,393. But if you see what the non-resident has done, he has lent 1 crore, he has received 1 crore. Where is the gain? The gain is only because the rupee has appreciated. At that time, when he invested, the rupee was 70, but now it's 64. I told you, when the rupee appreciates, the first proviso is harmful. So this was the problem. What the non-resident was saying, we will take the foreign exchange risk. We want to lend money to Indians, no worries. But your first proviso now is creating a problem for me. Because now if your rupee appreciates, then even if I have not earned anything, I have to pay tax. So government gives a benefit. It says, if rupee appreciate, then the capital gain relating to this appreciation rupee shall not be taxable. See what it says. In case of assessee being NR, any gain arising on appreciation of rupee. Now you understand from the first proviso. Whenever the rupee appreciates, there is an exchange gain for the NR which gets taxed as capital gain because of first proviso. You with me? So, in case of rupee denominated bond as well, had this fifth proviso was not there, this gain was taxable in the hands of non-resident as capital gain. So, the government exempts it. It says, in case of NR, any gain arising on appreciation of rupee against a foreign currency at the time of redemption of rupee denominated bond shall be ignored. So if there is a rupee appreciate, then such appreciation shall be ignored. Okay, so in this case, the entire gain of 13,393 is because of appreciation of rupee, and it has to be ignored. The capital gain shall be nil. So how you compute the appreciation? You compute it to a cost. So you invested $1 crore, 1 crore rupees, and you at the time of sale, the dollar is 64 rupees. So had it been 64 at the time of purchase as well, then your cost would have been 1 crore divided by 64. It would have been 1,56,250. So the difference, because of this, because of appreciation of rupee, the gain is minus 142,857. $13,393. So you earn exchange gain of $13,393 because of appreciation of rupee. Okay, and this amount is exempted. Is there also average rate taken? Yes, yes, yes. Average rate taken, because see, the computation shall be as a first proviso only. What the fifth proviso says, it says if there is a gain, if the capital gain is more because of appreciation of rupee, then I will ignore this appreciation. Only this thing. So what the benefit is given, if there is a rupee denominated bond, and benefit given to the NR is that if he invest in the rupee denominated bonds of Indians, then if there is any exchange gain because of appreciation of rupee, then he is not required to pay tax on such exchange gain, which is attributable to the appreciation in the rupee. Clear? See the next example. In this case, compute capital gain if bonds are redeemed at a premium of 5%. Now, he will receive 1 crore 5 lakh. Here invested 1 crore rupees. Similar average rate is used. Computation is only under the first proviso only. Understood, Sanjay sir? The fifth proviso only gives the benefit here. It exempts the gain. It gives a relief in respect of gain, which is in respect of appreciation of rupee. So I convert it by taking the average rate only. Dollar, INR, there is a gain, but I give the relief of 13,393 and I will tax only 7,813. Had fifth proviso was not there, then this 21,206 was taxable. Okay? And how you compute 3313393? You will convert the cost into the same rate which you applying the same rate which you applied for converting the sale consideration. 64. Had there been no change in the exchange rate, then the cost would have been 1 crore divided by 64. 156250, as we did it above. Now the cost is reduced because of the exchange rate. The difference is allowed as a relief. We are going in real depth. See, now here what happens is that in the next example, if you see, the rupee actually depreciates. It was at the time of January, it was 56. Now at the time of redemption, it is 64. So if the rupee depreciates, then fifth proviso is not applicable. Fifth proviso only gives the benefit. It's only for your benefit. It gives the benefit when the rupee appreciates. It exempts the gain which is attributable to this appreciation. So in this case, if you see, the rupee depreciated. Earlier it was 56, now it's 64. So there is a loss of 22312, fifth proviso is not applicable. Rupee is depreciated, hence fifth proviso shall not be applicable. You are with me? So, one last topic in respect of capital gain. This is for Vodafone. So, if let's have a 5-minute water break, then we'll start with the Vodafone amendment. The amendment which was brought in the act to overrule the Vodafone decision. We'll discuss what was the facts in the case of Vodafone decision, what was the decision, and why the government is not happy, and what changes it had made in the act to overrule this. Okay? So let's break for a break. It's 9:53. Let's come back on 1958, means 7:58. Okay? Sorry. Okay. So what we have studied till now, we discussed the presumptive rate of taxation applicable for non-resident. In case of shipping company, the rate is 7.5%. Then we discuss aircraft, which is 5%. Then the turnkey power projects, 10%. Mineral oil, 10%. Cruise, 20%. And setting up an electronic manufacturing facility or facility for production of electronic goods, 25%. Okay. So we discuss in detail section 44B vis-a-vis section 172, section 115A vis-a-vis this mineral oil, and 44BBD, the electronic facility. Okay. We discussed it. So let me know if there is any doubt. Then we discuss first proviso to section 48, applicable to non-resident. Then we discuss the fifth proviso, which is applicable in respect of rupee denominated bond, the masala bonds. Now let's discuss the capital gain, the Vodafone. See, this is a landmark decision, though not applicable in current sets of facts because it has been overruled by the amendments. But this was a very important decision rendered by the Supreme Court in 2012. What happened is that, I tell you, assuming there's a company, Dutch company, Netherlands. There was 100 wholly owned subsidiary of this Netherlands company in Cayman Island by CGP. Then this CGP was having a 100% subsidiary, Hutch India, which was an Indian company. Okay, so this is India, it's outside India. So the structure was, there's a Netherlands company. It has a wholly owned subsidiary, in Cayman Island, CGP. Now the CGP has a wholly owned subsidiary, Hutch India. This Hutch India used to provide telecom service in India by the name SC. If you by any chance have read. Now, currently, Vodafone wants to enter into the Indian market and want to buy this SR business of the Hutch company. So what it did is that it want to buy this Hutch India. But instead of buying Hutch India, see, this is the tricky point. What it did was it bought the shares of CGP. It didn't buy the shares of Hutch India. It bought the shares of CGP from Netherlands company. So Vodafone went a step higher, a step upward. So instead of buying the shares of Hutch India, it bought the share of its holding company, CGP. So by that way, it gets the hold of Hutch India as well, because Hutch India is nothing but a wholly owned subsidiary of CGP only. So once I got the 100% share of CGP, I got the control over Indian company as well. So what the new structure became? New structure became Vodafone, then CGP, then Hutch India. You are with me? So Vodafone replaces the Netherlands. In normal course, it should have replaced the CGP. It should have bought the Hutch India. It should have bought Hutch India. It should bring Hutch India within as its subsidiary. But it was CGP. Now, because of this was the transaction. You understood the transaction? Do let me know if there is any doubt. Because it's important that you understand the facts of the case. So what are the facts? The buyer didn't purchase the shares of Indian company. It purchased the share of a foreign company. And this foreign company holds the entire shares of Indian company. Okay? Understood? So what's the problem? Problem is whether this transaction is taxable, means whether this Netherlands company, who's the seller? The seller is Netherlands company, the shareholder. Whether the seller is required to pay tax or to Indian government on sale of shares of CGP? This is the question. This is the precise question in this controversy. Whether the transaction of sale of share of CGP or sale of shares of a foreign company by a foreign company to a foreign company, shares of CGP by Netherlands company to Vodafone, is taxable in India or not? Why? What is the nexus? Why there's a question that why it can be taxable in India? Because this foreign company holds the entire Indian company. Okay. So when this capital gain can be taxed? See, we have studied this. You should answer me. Can it be taxed or not? See, section 911. We studied in the last class. It says capital gain is taxable in India if capital asset is situated in India. And what is the capital asset? The capital asset is the shares of CGP. And a share of a company is said to be situated where the company is incorporated. So clearly, the shares of CGP are not situated in India. And therefore, the argument of the assessee was this transaction is not taxable in India. Had it been taxable, the tax amount was $2 billion. See, 9 zeros. And this is in dollars. This was the tax amount if it qualifies as taxable in India. $2 billion. So, but you understand the logic of the assessee? That why it's not taxable? Because simple logic. Because what has been transferred is the shares of a foreign company, which is situated in a foreign country. It's not situated in India because it's not a shares of Indian company. And therefore, as per 911, it cannot be taxable. It cannot be taxed. It is not deemed to accrue or rise in India because the shares are not situated in India. See? What the Indian Tax Department was saying. Indian Tax Department was saying that this is just a shell or a conduit. The whole purpose of this transfer was to get a stake, to hold, to control, to own this Indian company. So the amount which the Vodafone has paid to the Netherlands company is only to acquire the Indian business. It has nothing to do with the share to CGP. So what the Indian Tax Department says, it says many things. It said that first, this is actually indirect transfer of asset in India. Okay. So what the department says that it said that it's actually transfer of shares of an Indian company indirectly by transferring shares of its wholly owned holding company. Second, it says it gives strength to this argument by saying that if you see the valuation report at which the shares were valued, the entire valuation derived from the shares of Indian company. Third, the CGP company, Cayman Island company, if you see the balance sheet of CGP company, it has no asset except the shares of Indian company. So the shares of CGP is deriving value only from the shares of Indian company. Fourth, even if you say that shares of a foreign company is transferred, but the Netherlands has also transferred the control and management of Indian company. And this control and management of Indian company is a capital asset situated in India. You with me? Any doubt? So what it says that? It says This is actually indirect transfer of shares of Indian company. The value, the CGP, the share CGP then value only from the shares of an Indian company. The even if you say that shares of foreign company transferred, but by virtue of transfer of shares of foreign company, by reason of transfer of shares of foreign company, in consequence of transfer of shares of foreign company, the control and management of Indian companies also transferred to Vodafone, and this control and management is a capital asset which is situated in India, and therefore the amounts received by Netherlands is taxable in India under section 911. So these are the primary argument before the court. The matter reached Bombay Court and then Supreme Court. The Bombay Court decision was in favor of department, but Supreme Court decision was in favor of assessee. So we will see what the Supreme Court said, which is the final authority. The Supreme Court said section 911 is a deeming provision. And you cannot extend the deeming provision. Deeming provision has to be interpreted very strictly. Okay. Second, it says that you have to adopt look at approach. What is look at approach? Look at approach means the approach, see what it as it is. So you see the structure as it is. You cannot ignore the CGP. But what the department wants to do, it wants to tax Netherlands by saying that it has transferred the shares of India. By this argument, you are ignoring this. You are saying the Netherlands directly forced India. In other way, you are saying this is a conduit company, has no business, is just a shell company. So Supreme Court said no, you have to look at the structure, you have to respect the structure. More so, when this structure has been there for many years. Hutch was doing this business in India with this structure many years. It's not that when Hutch wants to sell the business, Indian business, it interposed CGP. This structure has paid huge taxes in India, has generated a lot of income in India, has paid huge taxes in India. You have to respect the structure. Also, you can ignore the structure when there is preordained transaction. What is preordained transaction? Preordained transaction means a transaction which was since beginning, since the inception, it was each and every argument of the Supreme Court, one by one. Supreme Court said that control and management is not a separate asset. They say no. We will tell you. They amended section 214 to say control and management is a separate asset. Then, if such asset transferred by reason of transfer of a share, then we include it as a transfer, with the definition of transfer. Then section 9, they said that through includes not direct transfer, indirect transfer as well, by reason of. Then they said that a capital asset, this is the most important amendment. A capital asset being any share or interest in a company or entity registered or incorporated outside India. So if we are talking about a shares of foreign company as capital asset, so talking about that, if the asset transfer is a share of foreign company, that such assets shall be deemed to be situated in India. So share of a foreign company generally situated where? Where the foreign company is incorporated. But it shall be deemed to be situated in India. The share of foreign company shall be deemed to be situated in India when if the share derives directly or indirectly its value substantially from the asset located in India. If the share of a foreign company derives substantial value from its assets located in India, then the share of foreign company shall be deemed to be situated in India. You're with me? Once the capital asset is situated in India, then on transfer of such capital asset, the capital gain shall be taxable in India. So by this amendment, by shifting the status of the share of foreign company, they have made Section 911 active. So now Netherlands, CGP, and India, they say the share of CGP shall be deemed to be situated in India if they derive their value substantially from the Indian assets. So if in the balance sheet of CGP, the more than 50% of the assets are Indian, then I will say that CGP, the shares are situated in India, and on transfer of the shares of CGP, the gain shall be taxable in India, shall be deemed to accrue or arise in India under Section 911. You are with me? In this case, the 100% of the value of CGP was deriving from the shares of Indian company, because in the balance sheet of CGP, the only asset was the investment in Touch India. It doesn't have any other investment, any other asset. So my entire value, entire value of share of CGP was deriving from the shares of from the asset in India, and therefore it said that I will deem that share of foreign companies also situated in India. Understood? So if you see CGP investment balance sheet, investment in Indian companies 1,000 crores, amount in crore. Investment in Dubai companies 9,000 crores. Here, the shares are not deriving value substantially from India. The Indian part is only 10% of the total. So if you transfer the share of CGP, in this case, it will not be taxed in India. But if the value of Indian asset was 7,000 out of 10,000, then if you transfer the share of this company now, the foreign company, still the seller of this company is liable to pay tax in India. You're with me? Let me know if there's any doubt. But in this case, of course, see, if the shares of this company has been transferred, then the entire capital gain cannot be taxed in India, because the Indian part is only 70%. So the law says only proportionate amount of capital gain shall be taxable in India. Clear? Now, there are some exemptions provided. So by this amendment, the decision of Supreme Court has been overruled, and now in similar transaction, the Netherlands company is required to pay tax in India. You understood how? What are the codes of amendment which make it possible? So in this case, companies like CGP will be taxed in India for capital gain. Partly, yes, means your concept is right, but the tax is on the seller. So seller, the person who is selling the shares of CGP shall be taxable. The share of CGP is actually the capital asset which is being transferred. The tax is on the seller who is transferring the capital asset. Okay. Okay, Hutch SR in this case. Yes, Hutch Netherlands. But because of this, some general problem arises because of this amendment. So they have given some exemption. What is the exemption? Transfer is made by non-resident of capital asset being investment in category 1 FPI. So if the foreign non-resident has invested in a foreign portfolio investor, which has subsequently invested in Indian company, and if the non-resident transfers the shares of FPI, then this is not applicable, of course, because the intent of non-resident is not to control the Indian company. It's only for the investment purposes. Secondly, transfer is made by non-resident outside India if transfer at any time in 12 months preceding the date of transfer neither hold the right of management control in relation to such entity, nor hold voting power or share capital interest exceeding 5% total voting power of such company. Okay. So if either of these two conditions to tax, both these two conditions has to be satisfied. This is similar, where all the assets owned by the company or entity referred to in expression 5 are not located in India. In our example, it was only 70%. The income of non-resident transferor from transfer outside India of shares or interest in such company shall be only such part of the income as is reasonably attributable to the asset located in India. You can tax only Indian income. Another assumption is given. The share or interest shall be deemed to derive its substantial value from assets located in India if on the specified date the value of such assets exceeds 10 crore. So if the value of Indian assets exceeds 10 crore, only in such case this explanation, this provision is applicable. So if you see, if in resume, foreign company balance sheet, there is Indian company shares, which is for 5 crore, and their other assets outside India for 1 crore. Total balance sheet is 6 crore. Though India, the value of India is more than 50%, but still, the share of this foreign company shall not be deemed to be situated in India because the assets are less than 10 crores. So they are giving exemption to small companies. And represent at least 50% value of all the assets owned by the company as a Cayman. So, and when we have to compute this value, when we have to do at the time of transfer, by the time of transfer, it's not possible to draw the balance sheet of the foreign company. So it says you will consider it on the day immediately preceding the date of transfer. So if the balance sheet is made on, if transfer is made on say 1st October 26, then I see the balance sheet on 31st March 26. Whatever the accounting year of the foreign company is, if the foreign company is following the calendar year, then I'll see the balance sheet on 31st December 25. So whenever the last balance sheet preceding the date of transfer was drawn, I'll see the value as per such balance sheet. Okay. Provided the difference should not be more than 50%, 15%. So correct. What it says that specified date means the date on which accounting period of the entity ends preceding the date of transfer. Okay. However, the date of transfer shall be the specified date. I'll consider the specified date. I'll see the value on 1st 10/26 only. When? In a case where the book value of asset of entity on the date of transfer exceeds by at least 50% of the book value of asset as on last balance sheet date preceding the date of transfer. Okay, understood? So this was a small but important concept for you for Vodafone amendment. This is very simple question. The important part is that the shares of a foreign company is transferred and it says the total value of the asset of such foreign company was 15 crore. Total value immovable property worldwide was 12 crore. And immovable property in India was only 8 crore. So if you see out of 15 crore, 8 crore asset was in India. So the India has a substantial value in the assets of the foreign company. But since the assets in India is less than 10 crore, it will not be deemed that a share of this foreign company is situated in India. Okay, you're with me? This complete our capital gain. Now we are moving to our third topic, which is tax rates. Very simple topic. Tax rate applicable in case of non-resident. Okay. So what it says that the tax rates are given in the series of section 115. Okay. So the section differ depending upon the nature of the non-resident. This section 115 AB. It's applicable on Overseas Financial Organization, OFO. That is OFO, we'll discuss in a minute. It's applicable if the OFO has units. This means mutual funds purchased in foreign currency. The mutual fund may be equity oriented or debt oriented. What the income is this UOFO is driving the interest income from a debt-oriented mutual fund, of course, or from long-term capital gain from transfer of units of this mutual fund. The income shall be taxable. The interest income shall be taxable at 10% and LTCG at 12.5%. In all these cases, we'll see a different tax rate in different section. Now, the LTCG will always be taxable at 12.5%. But for computing the LTCG, you will not give the benefit of first and second provision. Chapter 6 deduction shall not be available, but the brought forward losses and basic assumptions shall be available. Okay. OFO means any fund or institution established in a country outside India, which has entered into an arrangement for investment in India with a public sector bank or public financial institution or mutual fund, and such an arrangement is approved by the RBI, SEBI. So what it says that there is an organization outside India which has entered into an arrangement for investment in India with the Indian bank. And this arrangement is approved by SEBI. So once it invests in India in the units of a mutual funds, Indian mutual funds, then the income which is derived, either the interest or the long-term capital gain, shall be taxable at the rate of 10% or 12.5%. Okay. Next section is 115AB. It's applicable on FII. You must have heard the name foreign institutional investor. They are the person who are responsible for movement in my stock market. So 115AD says how this FII are taxable in India. So the asset which they own in India is any security other than unit referred to in 115AB. They're not talking about mutual funds, but they're talking about the securities, share, debenture, bonds. Income which they are driving, they're either driving the interest or the dividend or capital gain. The tax rate is, in case of FII, the interest or dividend shall be taxable at 20%. But in case of specified funds, this is taxable at the 10%. Short-term capital gain, other than the gain referred to in 11A, is taxable at 30%. And long-term capital gain is taxable at the rate of 12.5%, except 112A. Though 112A is also have a rate of 12.5%, but in 112A, there is exemption of 1,25,000. Such exemption is not available in case of 115AB, AD, AC, etc. Before this, let's do one more section which is important. 115AC in the series. We have done 115AB. Is applicable on OFO. 115AD is applicable on FII or specified funds. Now we are doing 115AC. It's applicable on transfer of GDRs. What are GDRs? GDRs, nothing like we have a shares in our stock market of Indian companies. The Indian companies' shares are also listed outside India. And when they're listed outside India, we call them Global Depository Receipt, GDR. When they are listed in America, we call them ADR, American Depository Receipt. But if they are listed outside India, we call them GDRs. Okay. So Infosys share are listed in Indian Stock Exchange as well, in the exchange of foreign country as well. So when they are listed in the exchange of foreign countries, we call them GDRs. So what happens? We are discussing the tax on income from bond or GDR purchased in foreign currency. The assessee is non-resident. If he has purchased the bond, foreign currency convertible bonds, or the GDR, then either he will derive interest or dividend on such bonds. If it's a bond, then he will derive interest. Or if it's a GDR, he will derive dividend. Such interest dividend taxable at 10%. But no deduction shall be allowed. And if he is driving the long-term capital gain arising on transfer of such bonds or GDR, these are taxable at 12.5%. I told you, LTCG will be taxable in every case at 12.5%. First and second provisos not allowed. No deduction of chapter 6A. NR is not required to furnish return of income if tax has been deducted at this rate. Okay. This we have discussed what are GDR and what are bonds. Now, one small section, 115 BBA. It's applicable on sports person and entertainer. Sports person who is not a citizen of India and also not a resident in India or non-resident, not a resident. If this person is a sports person or entertainer, if this person is driving income from India, then such income is taxable under section 115 BBA at the rate of 20%. In case of sports person, the income referred to therein is primary income is the income from participation in the matches in India and sports competitions in India, or if he has an income from advertisement in India, or if he's contributing some article in the newspaper, then he is drawing from such newspaper article. All this income are taxable at the rate of 20%. If there is some sports association, say Cricket Board of Australia or somebody, if they are deriving some income from India for matches in India, then their income is taxable by 20% in this section only. If there is an entertainer, say Michael Jackson or something, if he performs in India, then the income which he derives from this performance is taxable by 20%. You understand, all this income is actually accrue or rise in India because the event is actually happening in India. The sports person is playing in India. The entertainer is performing in India. And therefore, this income accrue or rise in India, but they have given the average tax rate on presumptive basis, they're 20% over. So what it says that we assess a sportsman who is not a citizen of India and also not a resident. Income from participation in India of any game of sport, advertisement, or contribution of article relating to game or sport in India in newspaper. Taxable at the 20%. When assesses a non-resident sport association, income by way of amount granted to be paid in relation to any game or sports played in India. This sport association is taxable at the rate of 20%. When assesses entertainer who is not a citizen and non-resident, income from performance in India, accrue or rise in India, taxable at 20%. No expense shall be allowed, no deduction shall be allowed, not required to furnish return of income if this is the only income and tax has been deducted. You with me? Same provision which we have already been studying. Let's see if I have some questions for you on this topic. Yeah, here it is. Question number 23. Can I read? In the financial year 25-26, another, a tennis player, and a Spanish citizen participated in India in a tennis tournament. So, a sports person who is not a citizen of India, and he won a prize of 15 lakh. So, this prize is taxable at the rate of 20%. He contributed articles on the tournament in a local newspaper for which amount of rupees 1 lakh is payable to him. Again, taxable in India because newspapers in India, 20%. He also earned rupees 5 lakh from a soft drink company for appearance in a TV advertisement. Again, taxable in India. Although his expenses in India were met by sponsor, he had to incur rupees 3 lakh towards travel cost. Not relevant. No deduction allowed. He was a non-resident. Good. So 115 BBA applicable. Tax liability. So tax liability is the receipts are 15 plus 1, 16 plus 5, 21. So 20% of 21 plus cess. So 21 lakh, 20.8%, the tax liability is 4 lakh 36,800. Okay? Perfect synthesis. Good. Now, We are moving to our last topic and the important one as well. This is regarding taxation of non-resident Indians. We are talking about NRIs, Indian citizens who are actually being abroad, who are non-resident. So this NRIs, there is a separate chapter to govern their taxation, chapter 12. First thing is, this chapter is optional. It will provide some tax rate, some computation mechanism, but this is optional. The NRI may opt for it, may not opt for it. Okay. So what it says that a non-resident Indian being an individual who is a citizen of India or a person of Indian origin and who is non-resident. Who is eligible to opt for this chapter? This should be an individual who is either a citizen or a person of Indian origin and a non-resident. So we are talking about NRI. You understand the meaning of a citizen and person of Indian origin? We have discussed. Citizen generally means a person who holds an Indian passport, and the person of Indian origin means a person, either of his parents or any of his grandparents were born in undivided India. So I told you, we might be the last generation to qualify as person of Indian origin. First, the definition. So foreign exchange assets means any specified asset which the assessee has acquired or subscribed in convertible foreign exchange. So we are talking about some Indian asset which this NRI has purchased in foreign currency. What are these specified assets? The foreign exchange asset means specified asset purchased in foreign currency. And what are the specified assets? Specified asset means share of Indian company, debenture of Indian company, not a private company, deposit with Indian company, not a private company, security of central government of India, or any other asset central government may specify. So we are talking about shares or debenture bonds of an Indian company. So what we are talking about? We are talking about an NRI who has made investment in shares or debenture of Indian company, and such investment made in foreign currency. You are remembering something similar, first proviso to section 48. So now, what is the income which this chapter is concerned with, is dealing with? It's dealing with two types of income. Generally, not generally, but a question may ask from this chapter. So that's why we are doing it in deep. So what it says that it first consider the income, investment income derived from foreign exchange asset. So the income derived for investment income means if it is a share, then dividend, a debenture of bonds, then interest. So such income shall be taxable at the rate of 20% without allowing any expenditure. Okay. Or long-term capital gain arising from transfer of foreign exchange asset. If these foreign exchange assets, share or debenture are transferred, then the long-term capital shall be taxable at the rate of 12.5%. A benefit of indexation not available, which is even otherwise not available. But it doesn't state that first proviso is not applicable. First proviso is still available. Another important thing, the income referred here is investment income and LTCG. It doesn't cover STCG because government doesn't want to give a benefit if you hold it and sell it, hold it and sell it, hold it and sell it. They want that you hold it for longer time. Okay. So this chapter 12 is actually a beneficial provision because it gives a concessional tax rate. The investment income is taxed at 20% and the LTCG is taxed at 12.5%. Okay. Chapter 12 applies whether the shares, debenture are listed, not relevant. The only condition is the share debenture should be of Indian company purchased in foreign currency. This section 115F. It says that this long-term capital gain from sale of this foreign exchange asset shall be exempt if the net consideration is invested in a specified asset within 6 months. So if you sold a share, are there any other asset specified as mentioned in the point V? No. The central government has not specified any other asset for the time being. The option is open, they may, but for the time being it's not. So what I was discussing that the long-term capital gain arising from sale of foreign exchange assets shall be exempt. See, it's taxable at 12.5%, but it's taxable only if it is not exempt. You can claim it exempt, the NRI may claim it exempt if it invests the net consideration into the specified asset, into a share debenture of Indian company within 6 months. We are talking about similar to first proviso reinvestment. So if you sold the shares and you reinvest into the shares of another company, another Indian company, then the long-term capital gain, which you earned from the sale of first transaction, is not taxable, provided you invested within 6 months. So it says, long-term capital gain arising from transfer of foreign exchange asset shall be exempt if SSC has invested the net consideration in acquisition of specified asset within 6 months from the date of transfer. See, if you see a little carefully, the gain is arising from transfer of foreign exchange assets. It is exempt if the amount is invested in the specified assets. The words are different. The law has used the word different. What's the difference between the two? Foreign exchange asset is also specified asset, but purchased in foreign currency. But here, if I am talking about the reinvestment, I have sold a share in Forces. Now you will give me the benefit. I have again invest in the shares of Reliance. Then similar thing, you don't want me to take money back and again bring in India and bear the commission cost. And therefore, at first, if you brought the money from foreign currency outside India to India, you purchase foreign exchange asset. Now, even if you invest in a specified asset without the foreign currency, then still the exemption is available. But the new asset, the specified asset, should not be sold within 3 years. If it is being sold, then the capital gain exempted shall be taxable as long term only. This type of provisions we have already studied in section in capital gain chapter, in section 54, 54F and all. Where SSC transfer otherwise convert the new asset into money. New asset means the shares or debenture, means the specified asset. Within a period of 3 years from the date of its acquisition, the amount of capital gain earlier exempted shall be deemed to be the LTCG of the previous year in the new asset so transfer. Means there is a lock-in of 3 years. Other provisions. Non-resident Indian is not required to furnish return of income if his total income only includes the income referred herein and TDS has been deducted. Similar. See, I told you this is optional. Assessee may choose in the return of income to not to be governed by the provision of this chapter in a particular assessment year. So year on year, you can choose whatever is more beneficial to you. Where a non-resident Indian becomes a resident any previous year. So if earlier you were an NRI, now you have become a resident. He may continue to be governed by the provision of this chapter. And while you was in NRI, you made some investment in India for an exchange asset. So even if you have become a resident, you can continue to be governed by the provision of this section in respect of such foreign asset which you purchased when you were NRI. So what it says, where NRI becomes a resident in any previous year, he may continue to be governed by the provision of this chapter in respect of investment income from foreign exchange assets until the transfer or conversion of such asset into money. So it allows you. You had invested in the share debenture while you are as an NRI. Now you have become resident and you're still deriving interest or dividend from such foreign exchange asset. Then you can opt to tax such interest or dividend at the rate of mentioned 20% in this chapter. Assessee has to furnish a declaration to the IO with his return of income. No deduction chapter 6 shall be allowed against the above income. Okay. Understood? So let's see the question relevant for this. Question number 90. Mr. Joseph, a non-resident person of Indian origin, NRI, age 49 years, furnished the following information for the previous year ended 31st March 2025. Here's a table. Let's see what the question is asking in that. You are required to compute total income of Mr. Joseph and tax rate applicable on the above income for assessment at 25 and 6. You have to compute the total income and say which income is taxable at which rate. In accordance with special provision prescribed under chapter 12A, okay, which we just studied, applicable to and non-resident and other provisions of that. You have to say as per chapter 12A also and as per other provisions. Mr. Joseph has opted to shift out of default tax regime. So you have to compute as under the old regime. He has no other income. The applicable tax was deducted. Ignore interest. Okay. And the effect of first proviso. So let's see. Sale proceeds of listed equity share in A Limited on an Indian company on 31st March 2024. So he sold the shares for 6 lakh. The cost of acquisition of equity share of A Limited was 1,10,000. Okay. Expenditure holding exclusively incurred is 50,000. He had an investment in government securities, 81,000. Interest on deposit with public limited companies. So this is investment income. Here at 25,000. Expenditure income, earning such income is 7,500. Interest on deposit with private limited companies, 5,55,000. These deposits were made when Mr. Joseph was resident in India out of his taxable income in India. So they will not qualify as foreign exchange asset because they are not purchased in foreign currency. Fresh investment of shares in listed public company, 2,20,000. So there is capital gain and there is investment income. So what's the capital gain? 6 lakh, cost 110, and then expenditure 50,000. The capital gain is 6 lakh minus expenditure 5,50,000. This is net consideration. If you reduce cost, the capital gain is 4,40,000. But this capital gain you have invested in a share for 2,20,000. But since you have not invested the entire net consideration was 5,50,000. So you will be allowed assumption only proportionate. So out of 4,40,000, only 1,76,000 shall be exempt. How this is computed? 4,40,000 into the amount you invested, 220 out of the net consideration, 550. Had you invested the entire net consideration, the entire capital gain would have been exempted. So only 1,76,000 exempted. 2,64,000 is the LTCG, which shall be taxable under chapter 12A as 12.5%. Interest on government securities, you have to gross it up. The interest on deposit with public limited companies, select 25,000. Then interest on deposit with private limited company, 5,55,000. This interest is not taxable under chapter 12A. Why? Because this was invested when he was resident. This interest, 81,000 and 3,25,000, the gross up part, is taxable at the rate of 20%. The long-term capital gain is taxable at the rate of 12.5%. And the chapter 12A, but 12A is not applicable. 12A is not applicable on the investment which was purchased in Indian currency. This deposit with private limited company. Hope I'm clear. Next question. Mr. Adi, a NRI, subscribed unlisted shares and unlisted equity shares of an Indian company in 2008-9 for rupees 6 lakh. Okay. This share was sold by him on 5th March 2026, long term, for consideration of 9 lakh. Okay. Brokerage paid for sale of this share is 15,000. Okay. Compute taxable capital gain of Mr. Adi for the assessment day 26-27, assuming he has invested in specified asset rupees 3,50,000 before 31st March 26. So, cost inflation index is given, it's not relevant for me. The capital gain is shall be sale consideration 9 lakh minus expenses on transfer 15,000. My net consideration is 8,85,000, right? The cost is 6 lakh. So capital gain is 2,85,000. This capital gain could have been exempted entirely if the assessee had invested 8,85,000 in the specified assets within 6 months. The asset is sold on 5th March and investment is made on 31st March. So it is within 6 months. But he has only invested 3,50,000. So proportionate amount shall be exempt, which shall be 2,85,000 into 3,50,000 divided by 8,85,000. This shall be the exemption under section 115. Proportionate. You have done this in section 54F as well. 2,85,000 into 3,50,000 divided by 8,85,000. So the exemption is 112,712. And the taxable capital gain is 172,289. Okay. See, the note is here, this is not clear whether the shares which was purchased in 8-9 was purchased in foreign currency or not. In this example, we have assumed, the ICAI has assumed that it's purchased in foreign currency. If you take a different assumption, then the capital gain shall, chapter 12 shall not apply and the capital gain shall be computed in the normal provisions. Okay. So there's a question. The question is, it should be Indian company, whether it is listed or not listed is not relevant. Yes. So chapter 12A applicable, the shares of an Indian company, whether listed or not listed is relevant for chapter 12. Question 21. A non-resident Indian acquires shares in an Indian company on 1/1/2009 for rupees 1 lakh in foreign currency. We're talking about NRI. These shares sold by him on 1/1/2026 for 3 lakh. Okay. He invests 3 lakh in shares on 31st March 2026. So he invested the entire consideration in specified asset. So whatever capital gain he is derived, 3 lakh minus 1 lakh, 2 lakh, shall be exempt in the chapter 12. And these shares sold by him on 30th June 2026. Oh my God. He has sold the new asset within 3 months. He should have held it up to 3 years. But if he had sold the new asset within 3 months, then in the year of sale, the long-term capital gain which was earlier exempted shall be taxable as long-term capital gain in this year. So in the financial year, previous year 26-27, this long-term capital gain which was exempted in the earlier year, in the preceding year, shall be taxable as long-term capital gain in the next year. This share sold for 3,50,000. In addition to this, he will have to pay tax on 50,000 as short-term capital gain. Discuss the tax implication. The sale consideration 3 lakh minus 1 lakh, 2 lakh is a gain which is exempt in the year 26-27 assessment year. In the next year, the gain which was exempt shall become taxable because you have violated the condition. You have not hold the specified asset for 3 years. So LTCG of 2 lakh which was exempted becomes taxable. And STCG of 50,000 also taxable. The last question is the conceptual one. A non-resident Indian furnished the following data for computation of income for the previous year, 31st March 2026. To purchase from stock exchange, he purchased a share of Reliance on 1st Jan 2019 for 5 lakh US dollar cent in foreign currency. On the same day, he purchased a share of Tisco for rupees 6 lakh for foreign currency. But he purchased a share of Telco in Indian currency on 1st January 2017 for 8 lakh. Okay. So this is not a foreign exchange asset. These shares are sold in the year 25-26 on these dates for this amount. Okay. On 31st March 26, out of sale proceed of Reliance, this out of 12 lakh, 6 lakhs is invested in the shares of Grasim, and out of sale proceed of Tisco, 4,50,000 is invested in ACC on 3rd December 2025. Okay. Also, out of sale proceed of Telco, 10 lakh is invested in shares of LML on 29 March 2026. Okay. Compute total income of non-resident Indian to the best of its advantage. All the shares mentioned above are listed. So TTBR, TTSR is given. So if you do as per chapter 12A, then indexation is not available, but first proviso is available. Well, let's see. First, you will compute the gain on Reliance. The sale consideration is 12 lakh. You will convert it into foreign currency. The cost is 5 lakh converted into foreign currency. You will get a capital gain. Then you will convert that capital gain into INR. Then you will apply section 115F. Why? Because out of the sale consideration, you have invested in the shares of Grasim. Similar thing you will do with Tisco. But for Telco, chapter 12 is not applicable. So section 115F exemption is not applicable. Clear? I tell you. This is a full-fledged question where the non-resident Indian invested in the shares of Indian company partly by sending foreign currency, partly in INR. So chapter 12 is applicable only if the shares are purchased in foreign currency. So chapter 12 is applicable only for Reliance and Tisco. So chapter 12 says that LTCG shall be taxable at the rate of 12.5%. LTCG shall be exempt if the amount net consideration is reinvested in the specified asset within 6 months. So LTCG in respect of Reliance and Tisco shall be eligible for exemption. This exemption because here the net consideration, a part of net consideration is invested in the specified asset. Okay. The remaining LTC shall be taxable at the rate of 12.5%. But while computing this LTCG, I have to give the benefit of first proviso because first proviso is mandatory and chapter 12A nowhere says that first proviso is not applicable. So let's see till now. Only respect to Reliance or Tisco shares. So if NRI opt for chapter 12A, because I told you chapter 12A is not mandatory, it's optional. So if you opt for 12A, then capital gain shall be for Reliance, capital gain shall be computed by applying the fourth proviso in dollar. Then you will convert the dollar into INR. Then the sale consideration C of Reliance 12 lakh, but you have invested only 6 lakh. Then the exemption shall be proportionate 50%. Out of 5,80,000, 2,90,000 shall be exempt, and the balance 2,90,000 shall be taxable at the rate of 12.5%. Do let me know if there is any query. Similar thing will happen in case of Tisco. You will compute the capital gain as per first proviso. And but in Tisco, the gain are short term. Is it? It should be 25. So they were purchased on 1st Jan 25 and sold on 6th June 25. And since the gains are short term, the short term gains are not covered by chapter 12A. But the computation shall be done as per first proviso only because first proviso is applicable for both short term and long term. So this short term capital gain 1,80,000 shall be taxable at the rate of 20%. Exemption to section 115F is not available since it is available LTCG. Telco. For Telco, chapter 12A is even not applicable. Why? Because it was purchased in Indian currency. The period of long term, sale price may cost 4 lakh. This 4 lakh shall be taxable under section 112A at the rate of 12.5% in excess of 1,25,000. This is the gross total. Okay. Had it not opt for Chapter 12A, then all these gains, the gain on reliance would have also been computed under Section 112A without giving the benefit of first proviso. This will be 7 lakh. Simple. 12 lakh minus 5 lakh, sale minus cost. Other two amounts would have been same, because for the telco we have not given the benefit of 12A because the share was purchased in Indian currency. For Tisco we have not given the benefit of Chapter 12A. Why? Because it's short term. So the capital gain would have been 12,80,000. Taxability would be this 7 lakh plus this 4 lakh shall be taxable under Section 112A at the rate of 12.5% in excess of 1,25,000. And this 1,80,000 shall be taxable at the rate of 20%. So we'll compute the tax liability under the both Chapter 12A, as the way I told you, and without outside Chapter 12A. Wherever the tax liability is lower, you can opt for that. You can change your option year on year. You means the NRI. Okay? Clear? So this completes our class for the today. I hope you got what I want to say. Do let me know if there's any query. Try to be conceptually strong to help you to retain the provisions. You don't need to remember the section. You may, but it's not mandatory. Focus on the provisions, what the section says. Okay. Anything you want to ask? What will be covered in next class? So in next class, we will do the TDS applicable to non-resident and exemptions applicable to the non-resident. We have a schedule of 5 classes. So this was our 3rd class. In the 4th class, we will do TDS and exemption. And in the 5th class, we will do the miscellaneous topic applicable to the non-residents. This will cover our Chapter 21 of the module and our taxation. Okay? Any question? Okay, thanks. Thank you, sir. So, goodbye for today. Good night. And we'll meet in the next class. Thank you, sir. Thank you, ma'am. Thank you, Dhruvi, ma'am. Do let me know if there's any question. See, the intent is your interest in the subject is a reason. That's why I try to go deep to let you know the reason why this provision was made. So that it helps you in retaining the provision and you start liking the subject. It's very interesting subject, have a very practical applicability. And see, once you become a CA, nobody is going to ask you what is the accounting entry. Though you are a chartered accountant, but wherever you go, you'll be seen as a tax expert, as a doctor of a tax. And everywhere you will be asked the question regarding how to save income tax, how to save GST. I have received this income tax notice. I have received this notice. How to deal with it. My case is in the ITAT. How to deal with it. Is there any provision? So this will help you. This will help you in, if you have interest, because see, if there is something which will be with you for the entire life, this tax will be with you once you become a CA for the entire life. So it's better to do it very strongly. So you get a very comfort, you don't get discomfort every time. So you have to live with it for your entire life. So that's why once you have started, do it all and put all of your 100%. It's very, very simple and very interesting. If you understand the reasons, then it makes a lot of sense. The law is always logical. If you feel it's not logical, then at least at first try to question yourself. You must be understanding something wrong. Normally, the provisions are almost logical. If you find it illogical, either you don't know the background. In most of the cases, there may be some exception, but most of the cases, either you don't know the background, that's why you're not appreciating the provisions. Okay? And my job is to to make you feel comfortable, make you feel good in the tax provision, so that you don't fear from this provision. This NRI taxation is actually a little bit complex concept. People actually fear from this. I'll tell you, the meaning of business connection, the meaning of term royalty is still not clear to many professionals. Hmm. And this is the time where you can actually focus on the concepts. Once you become a CA, it will be very difficult for you to actually go back to the concepts. So there will be lot of things. So there's a time for everything. And this is a time to get your concepts clear, to get hold on the subject, whatever you're doing. If you're doing the subject for the first time, do it very thoroughly, so that from inside you get a confidence that I know this subject. Once I will revise, I'll brush up everything. Okay. So lot of gyan. Yeah. Yeah, I'll try. Thank you, Sanjay sir, for the kind words. And I'll try to pass on the knowledge what I have got since all these years. Yeah. Okay. So if I show you, I'll show you. I take just 1 minute. It's there in front of me. See, this is the book. And this book covers only, if you see, section 1. I'm not sure you're looking at, I think camera is not. Section 1 to section 13. See the size of the book. See the size of the book. It only covers 13 sections, section 1 to section 13. These are called commentaries. You don't need to read these type of books at this stage. But if you have an interest in a subject now, once you qualify, you would like to read this type of book. These are actually the ocean of whatever is there in this provision. So I try to read these books. These are commentary of Sampath Iyengar. And they are commentary of many authors. These are Sampath Iyengar commentary. So we try to read these books so that we can tell you actually why this provision was introduced and all these things. So intent is key. We do this hard work so that you could get that understanding and interest in the subject. Because our teachers also did that. That's why we have this interest. Okay. So let's meet in the next class. Good night. Thank you. Yes, Mr. Sanjay, taxation is very important. I'll tell you, you are actually a tax doctor. It's only you. It's only in the CA curriculum the tax paper is studied so deeply. Lawyers, CS also practice tax, but they have not studied the tax. Trust me, they have not studied tax in such a depth which you have studied as a chartered accountant. Though we are accountants, but we are known as a tax doctor because we have actually spent thousands of hours in taxation. We, as a tax doctors, are the backbone of this country. Even the